But just like anything else, you learn the fastest by doing it. Now, this is, if you understand that, right, then be smart about it. Don't use $20,000 to go in there and try to be 10% of any pool when you don't know what you're doing. Use maybe like $200. And for those that go, that, you know, they're like, oh, he's pretend like $200 is nothing, then just don't do anything, right? Because then you're getting into a realm that the data that you collect on it, whether you made a mistake or not, like generally, okay, this is what my approach was. I don't understand it. I know it's risky. I don't give a shit. I want to learn. I don't want somebody to tell me how it works. So let's go do it. Let's go do it with smaller amounts, and we can extrapolate the numbers. Like I told you about the pool percentages, right? There's a certain amount of liquidity that's there versus everybody else. You don't need to know how many other people are there. You just need to know how much capital you have versus the rest of the pool. And you also need to make sure that the volumes that are coming through on the pairs that you're providing liquidity for are high enough to suffice for taking the risk in the first place, right? So if you can manage all of that, then that's what you need to hunt for based on how much capital that you have. So like, I guess I am kind of agreeing with you in a certain respect there, Mango, but also I am kind of disagreeing with you and explaining my point why. Because there's other liquidity pools that are smaller, the smaller amount of capital that you have, you can shoot for the stars, I guess, right? 10% is pretty good for 20 grand. And to some people, 20 grand ain't shit, really. But even if you were 1% of the pool with 2 grand, like that's still pretty good. 1% of $787,000 is pretty good. I mean, that's pretty damn good.
Do you think that putting, like, if you really learned how to do this, that you could make more money doing this than just buying HEX?
If you're able to dominate the liquidity pool, where you know that you're one of the bigger players, and more or less the other players that come in that are smaller, that are watching for you to move. Like I told you, sometimes you have to watch the other, like in HEX, you have to watch the other bigger liquidity positions move so you don't get left behind. You kind of want to be the one that doesn't have to worry about getting left behind, right? So being early in on these assets can give you an advantage that the whole community is rewarded based off of your knowledge, right? If you were just a dumb fucker and you didn't know what you were doing and you had all these assets, chances are you're probably going to make a bad move, and the community won't have any reason to think that was good at all. Not even for them, not for you, not for anybody. But if you know what you're doing, then it'll be a healthy marketplace for you and for the community and everybody else. And that's why I like HEX. That's one of the things that makes me enjoy HEX and got me so very, very interested on how prices are derived across the board when it comes to the blockchain. So yeah, I lost thousands of dollars. Even when you guys were all complaining about your gas fees and just making trades were like 30, 40, 50 bucks and stuff like that. We were providing liquidity positions for about $200 just to enter a position into a smart contract. $200 to remove it. That means that the fees that we needed to garner would have had to have been over $400 in a 24-hour period just to get some data, right? So we lost some money, but we knew it. We were already in the midst of doing this project previous to the fees going crazy and ape shit. And it was also previous to not the entire, but the majority of the uprun all the way to 52 cents for HEX and the rest of the market's uprun.
Is your goal looking for liquidity, like looking for fees, or is it like you want to help move the price in the direction that you want it to go?
That's what I was saying. Use it as a tool, because you don't even have to use it like for long term at all. Like I was saying before, if you were like right now when you saw the price in ICOSA go down to 90, what was it? Actually, it went down to 80 cents, 79 cents, 80 cents. So if you were paying attention, you had a bunch of ICOSA. Like most people were just trying to extract value and find edge cases all over the place and do all sorts of other shit. But I mean, if you had a bunch of those assets, I don't know, 20 grand, let's say, and it went down to 80 cents, and you knew that with the ceiling price that it was going to pull it, at least try to pull it up some from that giant dip that was there, even in the USDC price. You're taking a risk, at least. I mean, I guess the only risk is your assets just sit there and you don't get any fees, and the price doesn't go into it. And that would be worst case scenario, that the price just kept going down from 80 cents after you put it in there, which at this point you don't give a shit, right? That's fine. If it does keep going down, then it's going to cost, like with gas prices right now, maybe like $7 or $8 to remove it and then move it down further, if that was going to benefit you, if that was the case. And then you can just increase your range from the further down price all the way up to what the ceiling price would be, and then go ahead and mitigate your risk. Because like I said, the wider, less concentrated you make your ranges, the less risk that there is that you're putting to your assets in the first place. And you can capture a higher percentage of your overall average if it was to just rip from the bottom part of your range all the way to the top of it, and then you pulled it, right? Like you would have been able to sell for a higher average than what a lot of people had the capability of doing in the first place. Or if it wasn't, because it was such a high spread over the period of time, you can just leave it, like I said, you can just leave it in that range for a while until it makes up for it in the fees that you get, because now you are going to fee capture at that point. But you know it's not going to go higher than the ceiling, at least if it does, not for very long. So it'll just get slapped right back down to the high part of your range that you would have set after when this dip set itself in, meaning that the 80 cents to $1.07 or some shit, right? Whatever the ceiling was at the time. You know that now it's gonna be volatile over $1.07, even if it does go there. And you're already in a volatile range where you put it at, and you're going to be able to just use ICOSA, no USDC, to set the range. And then as the price goes up, it'll turn that ICOSA into USDC that you'd never had before. And then you can decide to pull it whenever you want if you're satisfied with that. But you can just let it roll sideways through this almost guaranteed, still risk, but since you know what you're doing, you have less risk than others, but almost guaranteed range of price where you know that you're going to be able to garner fees for a couple of days, maybe even a week. It kind of depends on, especially with all the events that are going on right now, maybe only a couple of days, garner the fees, and then pull it for the average of whatever the range was at the time, and then reestablish a new position. Or reestablish a new position if you have more assets sitting on the side, which most market makers do, and then pull the old range, because you don't want to make too many things volatile, right? So sometimes you'll, like, let's say that you were one person and you were the entirety of the $216,000 worth of liquidity. Imagine how volatile everything would be if the whole range was in a V3 in only a concentrated range. So you knew price was only going to go through there. Man, price calls would be easy if you knew it was only one person and that price could only be there and it was only them setting those ranges. That'd be neat. If you knew that, then that could happen, but typically not. That's not the case. But yeah, garnering the fees going sideways would be a good deal for a while. Pull that, reestablish. But like I said, generally, you don't want to cause high volatility. But if there's already a bunch of assets that are there in that range, let's say that I was the one that facilitated the lower price in the dip because I knew that there was going to be a bunch of people that were selling ICOSA. And I'm not saying this is true. I'm just saying that if I was to have paid it this close attention, hindsight being 2020, it's easy to speak now. So let's say that I saw this coming. I knew I wanted to facilitate that dip that was coming for people that wanted to sell and the price to be able to go down there so that the community didn't see just a wick to go down to this price and then go right back up to the ceiling price again right away. It allowed an opportunity for people to get in at a lower cost at that time, and only for the amount of time that I was selling that asset at that lower price. let's say it was only for two or 3 days, and everyone's like, oh shit, you better get this dip before it goes back up to the ceiling price. Is it? People are gonna be like, is it gonna go back to the ceiling price? Is it? Like YouTubers and stuff, right? How long is it gonna take? Well, it'll take about as long as the market makers allow for the facilitation of the lower price. So let's say it was me. We went through a couple of days, everyone got cheaper shit, nobody realized what was going on, and no market maker is going to come out and be like, you should be thanking me, right? No, absolutely not, because your addresses are your wallet is connected to those addresses in the first place. So you're not going to dox yourself. Nobody's going to know. And then what they do is they'll pull all that low range liquidity, and there will be no facilitating that lower price any longer. And now all the liquidity that was above, and even the person that pulled the liquidity down low, causing this really high volatility, there ain't no assets there anymore for anyone to buy anyway. And even if they did, it's going to shoot the price all the way up to the liquidity that's above where it used to be sitting at, which would be the ceiling price areas, right? So you could even go take what you removed down below and go slap it back up top again in a totally different safety range that you have, with the assets that you just appropriated from down below. You just pretty much scooped up a bunch of cheap ass assets for half the price, right? Because you've got all your USDC, you can just go make purchases, right? Previous to that, be the reason why all of a sudden people don't have this buying opportunity down low, because you just removed all the assets. You took some of the USDC that you had, you make a couple of those small ass purchases that make huge green candles, shoot the price up into the thicker liquidity that you just replaced, that you already implemented previous to doing this whole entire thing. And now you have manipulated the price. You came away up with a bunch of cheaper assets. Everyone was facilitated the availability for cheaper assets, and then you moved the price back up against everyone else. And then any of the smaller liquidity providers that moved their assets down lower to be like, oh yeah, apparently we're just going to be cheaper than what the ceiling price is for now, and I'm just going to move tight ranges because they don't understand down at this lower price and leave it there. And then now all of a sudden the price just went up above them, and they got pretty much put into an impermanent loss situation because the majority of the liquidity, which could have been me and maybe a couple other guys, moved all the liquidity up higher again, and you weren't part of the club. Nobody told you, you're just learning, right? So that's where I say those mistakes come in, because you don't realize that there's clubs, and not actual clubs, but these people with bigger assets that are watching each other move around. They don't have to talk to each other. They don't have to dox each other. They don't have to really organize any type of agenda or anything, right? It's just one big player decides that he wants prices to go up, and everyone else is like, okay, well, do we move? Do we follow where he wants to go? Probably go before the price goes there. If you follow after the price goes there, then you're probably already to the point where you're too late, right? Even Richard Hart was saying that fucking year and a half ago, 2 years ago, he was saying, you market makers out there that are following the price, you guys are going to get liquidated on the high end, and then when the price goes the other way, you're going to get liquidated on the low end. Stop following the price. What he wasn't saying was pay more attention to what you're doing, learning what you're doing, find out what those market makers are, those addresses with the big wallets that are always providing liquidity and moving the price they're moving their liquidity around to facilitate new prices. You need to follow them, not the price. Because if you follow them, you'll notice that the price follows them. Because they are, like I said, they're the ones that facilitate the availability for price to have sustainable deriving price, right? Otherwise, you get it so volatile that, everyone knows what slippage is. Nobody knows why slippage occurs is the problem. There's high volatile areas where there is no assets there for you to buy, and that's the reasons why that happens. And as soon as price goes down into the thickness of liquidity, which is where most of the volume is at. Now remember, that's one of the most important things to a liquidity provider, right? Is the volume. Because he knows that he can take a certain amount of his capital and be able to take up a portion of the total liquidity that's there, like having a pool percentage, I guess, right? 10% of the pool of $200,000, $20,000. And if the volume is diddly squat for days and days and days, because there's no excitement, there's nothing happening with this community, then you're going to move on to where there's excitement happening and where there's a community doing stuff to the tune of $780,000 for just having 20 grand sounds pretty good. That sounds really good to be able to get 10% of that pool for sure. And then what happens when other people start to learn these things, or other market makers that haven't quite, stumbled along the community yet and like looked at the pairs and knows what's going on, which is what they'll do immediately, snip that shit out. You'll notice that the liquidity pairs will start to get built up, right? And then it's after a certain period of time of, people providing actual V2 and multiple ranges of V3 getting set up all over the place, it allows for more healthy movement. It's harder for the price to move through really thick liquidity ranges. And if you just got a mountain of liquidity, then your slippage will be like 0.005%, 0, whatever the most minimum you can possibly ever have. And the community enjoys that, right? They can get more assets for their dollar. That's the most important thing for them. And then appreciation and speculative type of results, right? The community probably being positive is a good thing. Although with hexagons, I think it's, it doesn't quite matter. Maybe, I'm not sure.
Yeah, we generally are very happy no matter what happens. Or, yeah.
Seems to be that.
Users.
Hexagons can be nuts.
Thanks for sharing all that, man. That, at least for me, that was really interesting. Kind of gave me some stuff to think about in terms of liquidity. That was thanks. Yeah, thanks. That's cool.
Yeah, no problem. Like, I wasted a lot of money, and so did a couple of my buddies too. Spent a lot of money on gas fees to be able to just pull data. Just like what I was telling you. Well, if it was 20,000 to the 200,000, it would be 10%. Well, what if we just use $200 and see what the averages are per the volume that happens per day? And we can extrapolate the rest of the values out to what if we were the whale or the shark or the dolphin or the whatever the fuck. Who cares really, right? The values are still there. And as long as you can pull data from each different pair, you start to ask these questions like, why was volume on this pair like larger this day, or why was this one all of a sudden the one? You're now watching 13 different pairs, and your buddy has a fucking Excel spreadsheet that's pulling live API data from all these different sites to be able to show you what the volumes are versus the TVL versus the percentages that they're, and what if it would have been if you were a certain percentage of that pool for all of them. And then you'd be able to see where your risk patterns were for all of them, and then try to make sense of that shit, right? You're just kind of like, well, we have an overwhelming amount of data now. So if we not try to tackle the overwhelming amount of data, why don't we just try to figure out why the volume shifts from one to the next to the next to the next? And that's when we started to realize about the routing protocol for Uniswap and how it routes the pairs. Now you're going from this already complicated process to another complicated process and how they work. And it's like a math problem. Some really complicated math problems suffice for you to previously do other math problems first, figure out answers, and then the answers that you have from those other problems give you the meat that you need to give you the derived answer of this other complicated problem, is kind of what we were getting into. Thank God we did it that way, instead of being like, we got all this data that we need to dive into, and then spending a whole year diving into data for no fucking reason, right? Like we pretty much figured out that mitigating your risk for impermanent loss is based on your intelligence level, and when you pull the fucking plug on it, right? Like when you pull your liquidity and you cause impermanent loss is when you're, there's some gameplay to this whole thing too, other than just watching the other liquidity providers, watching price and all these other things. And sometimes I think that with TA guys, that is kind of like a self-fulfilling prophecy. I think that they're really good at making that statement too, that based off of like entry positions for a lot of people, because the fucking market makers were the ones that were consolidating at that time. Just like I explained to you, they were the ones that were facilitating those prices to be that way at that time, allowing for more and more community members to come in and get emotional with that price that they bought in at, right? So if it ever did go back down to that price, you knew that you had a bunch of buyers already, because you created that environment by allowing for a longer period of time for them to get in at. So then you create this environment as a market maker, and your TA guys don't understand what that is. They don't get it, but they don't have
that's
to.
Some good fucking insight right there. why that shows up on the chart as support is that the market makers kind of made it the support by providing the liquidity at that level.
Yeah, and the
that's
reason
what
why,
people think about. Yeah.
well, and think about this: the reason why that level was the level that the market makers liked and they left it there was because they know that the community liked it there because the volume picked up on those days while it was on those prices. So they're like, shit, we're riding sideways on this bitch until they're not happy with it, and then we'll move price up, we'll get them excited again, and then we can provide them with the higher prices, and we'll allow them to dump through our liquidity as long as the price is in the thickest prices, the parts of it, right? So that way they can maximize their value, and they can, as community members, they can go get excited and go do all these cool fucking things. And as market makers, we can provide those healthy environments for everybody to do these things, and still realize that since a lot of people don't know what they're doing, that they're going to not realize that prices in a volatile, like the lower side of liquidity, and go sell a bunch of shit and wick themselves and be like, oh fuck. Because most people, when they sell, they wait till the last minute where it's like there was nothing else that they could have done, and now they have to fucking do it. Now if the price is just sitting there, you're fucked. You're so fucked. You can't wait a week for price to go back up, or when the market makers decide to facilitate for you to go sell. They don't care. They don't even know, right? They don't know. So, I mean, it's just funny how it all plays out. And then watching everybody else trying to guess with their crystal balls and all this stuff and garner all this attention from all these people to lie to them and tell them that they know all this stuff is just kind of like, oh boy, here we go. You know, when are we going to learn all this stuff and then just provide something with the security of us being able to provide education without losing our anonymity? Because I ain't going on YouTube. I ain't doing that. Nope. And I'm not going to provide information that could be even scrutinized as financially in any way, shape, or form on YouTube with showing charts and how to do all this stuff and all these things. As soon as somebody does the wrong thing and they fuck themselves, because like I already said, this is risky, you ain't coming back to me to tell me that I did anything wrong, because I didn't even fucking show you how to do it. I just told you how it works, and allowing for you to have the opportunity for you to go figure out to do it and make your mistakes like I did. Right, I just did it during one of the more expensive, high throughput times during the Ethereum network, like a fucking, nerd, because I didn't care. We wanted with data. We were literally paying hundreds of dollars per transaction just for the data, right? Not to educate you, but we wanted to find out like how to mitigate risk and find these edge cases and be the advantage, right? Not just figure out, like, if you're wondering anything on how it works, then you're never going to be the advantage. If you know how it all works, then you know where the advantages are, and you know how to implement yourself into them and have the best availability of creating an environment that's best for you. And in the end result of finding those things out, the best way to do it is create a better environment for everybody. Is the best way to work that it works. So
yeah, man, good shit.
Yeah, get out there and try to mitigate your risks, and make some mistakes along the way so you can help further mitigate your risk. I wish there was a video that you could just do that would teach everybody all the nuances of all the stuff that could happen, but it's just simply not possible. Because if you were to, it's almost a live action reactionary thing of all the stuff and all the data that you need to pull in and look at to make a good decision is changing every 24 hours. So you don't even get a whole lot of time. Like if there was a video to tell you what's going on, they'd have to do a video on what they're about to do right now and the reasons why it's so pertinent. And the only people that would be able to garner any significance, some solid substance to it, would be the ones that are like, they're watching it at that point in time live, what's going on, how it's done, the reasoning behind why it's being done, and then gets to watch the end result of it happening as opposed to doing it themselves. Which, I mean, that could, like I said, that could take days, it could take weeks when it gets into these types of things on however you decide to implement your plan. And then the next day it could all change, right? Where you find out whether the plan that you implemented the day previous was the right move or not. So even when you do understand how it all works, there's still risk. There's literally zero way to actually mitigate 100% in permanent loss capabilities, unfortunately.
Well, one of the big takeaways I got from what you just said and made a lot of sense to me is if you're not paying attention to where the big liquidity is going, you're probably going to end up on the wrong side of it. You'll either get you'll get liquidated yourself on one side of the pair, because where that big liquidity stack moves is you're going to end up in a thin part of the liquidity and just get, you'll get, if like you're a small player, any price move is just going to go straight through your entire range, because you're not the one setting the big thick liquidity, somebody else is. And if your range is outside of their range, you're not going to get the volume because the liquidity is too thin in that area.
Right, and depending on how thick they have and how concentrated it is and how wide they have their range, they're already set previous to the price actually moving up, because what you don't know is that they also have lower range sitting at, and they just pull the rug out from underneath you by removing all the liquidity, and now you have to move up. And when the price, but you don't realize it till the price moves up already.
Yeah. Unless you're,
now you're only sitting at the high side of visual representation. So like what we were just talking about, the ranges can be whatever you want, obviously, but like I said, it's just a visual representation of what I meant when I was saying what I was saying. By setting your first range, letting price move up, set the next range, and then have that difference. Or you don't even have to. You could take both assets and set the range where you want it, the majority of it being USDC underneath it for the second range, so you can push it up higher than what the current price is. And then that last one, it doesn't have to be that small. I mean, you can have the overlaps as big as you want, but that gives you the generalized understanding for 3 different ranges, how you'd be able to capitalize and mitigate risk depending on which way the price goes, but still be able to be in range where you're getting fees at all times. You see what I mean? So you're never actually in range of any individual pool. So you're getting your fee range, your fee raking down to a science there, I guess, really.
Is the top arbitrary, the top and the bottom?
Well, I mean, I guess it depends on how you want to pull those ranges. So that very first one that you deployed there would be you selling assets. And if price did go all the way to the very, very top and you pulled it, then you would have been selling those assets for half of the entire price movement. But still, you would have been selling the top. And then on the second range is what you'd call buy the bottom range. So the first one is sell the top range. The other one is buy the bottom range. If you wanted to pull those when the price actually went to those ranges. But this is to cover you just in case it doesn't. If it just moves sideways, if you intend for it to move sideways for a while or a couple of days, then you can do this, right? Until you garner enough fees. The best case scenario is that the 24-hour fees that you saw that were able to give you the percentages that you'd be able to get off of your pool share, that you'd set up something like this after you were really confident that that was the case, right? But if that wasn't the case, then, you know, maybe there would be other games that you'd want to play and other types of ranges that you could do as far as trying to find, like, there's not really an ARB, I guess. This would be the facilitating and availability for other people to do ARBing and things like that. But I mean, you're getting trading fees. So the more trading fees that happen on volume, obviously it's better for you. So you can find a pair that has like a fuck ton of trading fees and do that, what I just showed you right here, where price would happen to be exactly riding through the middle of them. Then you'd be capturing the entirety of that range's fees only to a certain extent for the ticks of the price that's there. And that's another thing. I mean, we can get into that too. So where the overlaps are at, let's say that the first range was 10 grand, the second range was 10 grand, and then that third range was 10 grand, so for 30 grand. Only where the overlaps are at of, what did I put on there? 10%. So it would only be 10% of the first 10 grand, 10% of the second 10 grand, and then the entirety of the whole 10 grand in that purple bar there. So really, instead of it being 30 grand of you in the pool, it's 10 grand of the purple bar, 10% of the first one, and 10% of the second one when you're in those ranges collecting fees on how much you'll get for that 24-hour period. And that's where it also gets kind of confusing too, because you're like, if you have liquidity being provided where the price isn't at and you're not in range and nobody's buying it, you're not getting any fees. So you want to make sure that you're in those ranges there on top of the liquidity that's there. So it's kind of a skewed thing, what I said earlier about if there's $220,000 of liquidity and you're 20% and you're 10% of that liquidity with $20,000 and it's $750,000 worth of volume that's coming through at that time, then you're going to get 10% of that $750,000. That's not exactly true. If the entirety of that $750,000 happened to go through your ranges the entire time, then that would be true, right? And if it used the $10,000, the whole $10,000 throughout the range, going back and forth throughout it, within that 24-hour period, then it would absolutely be true. And the more that it does that, the more that you're going to garner per day of an actual percentage. So it's intriguing to be able to find that, because 1% per day over a year And like I just explained to you, chances are you wouldn't be able to provide one range for a whole year, even if it was V2. But 1% per day would be 365% APY per year. If you can extract that out of 20 grand, 365% per year, then you have figured out how to play this game. If you can figure out how to extract 0.5% of that per day, then that's like 180%, right? Or some shit like that, just below it.
Yep.
So now you're really starting to figure things out. And that means that your efficiency just doesn't need to be as good, right? You just need to make sure that your overall average is at least 0.5% a day, and you should be pretty good. But it could be less than that. It could be like 0.35% a day, and you would have 100% of your entire total. But you need to know how to play the game, and you need to be forward thinking, and you need to be mindful, and you need to be able to watch, and you probably need to not have a job. Like this would be your job now.
Yeah.
Yep. But if you can make 1% of $100,000 a day, think about that. If you are capable and good enough to be able to make 1% of $100,000 a day in the pools, then that could be at a maximum an additional $365,000 off of the 100 grand.
So when I'm assuming that you had stuff to do while you were doing this, do you have some setup for while you're like on vacation or something?
For your ranges, you can use Uniswap on mobile. It's not very nice, but you can. And you can monitor all your ranges on revert.finance. You don't have to hook your wallet up. For those who are, let me click it, make sure it works too. Yeah, so just copy paste your address into the address bar on there when you are providing liquidity, or you can copy paste anybody's fucking address into that thing and find out if they are providing liquidity. You can also see where all their previous ranges for the entire history of their whole wallet were opened and how much money they made, and that's kind of neat. You can see a little bit of everything. Takes a little bit getting used to, but as you start to understand the information, it makes more sense. I wouldn't use it to track people. I like I said, I would just use it to track my stuff, especially if I was on the move, because you can use this revert.finance on mobile as well if you are traveling. Go ahead.
Are you, I forgot what I was gonna say, are you do you have like alerts set for when certain things happen?
Not really. I'm just like manically always checking the charts when I'm away from the stuff, because I'll know in my head where all my ranges are and where stuff's at. So all I need to do is look at a price chart to know where things are at for the volatility and the risk that I deployed, minus like looking at all the money and the fees and all the stuff. I don't care about that. Like, I know where the percentages are based off of where the price would be at, because I'm the one that set and established the ranges. But I wouldn't like set up a range that like was concentrated, that would require for me to sit there and watch it more than a couple times a day if I was going to be going on vacation. But if I still wanted to provide liquidity and I was pretty confident that I wasn't going to fall out of range, then I might open up a range that's like really wide, just to facilitate the availability for the community to use my ranges, because it's better than it just sitting in my wallet doing nothing, right? Like some people have assets, like, yeah, you could just stake it, but it's like, I already have, like, I have so much, like, you don't even realize, like, I've got so much stake that it becomes stupid to continue to keep doing that. So instead of just letting it sit here in my wallet, then I can just provide communal behavior, right? I can just go allow for people to buy and sell and trade assets across ranges and stuff like that. And some people are just like that, and it's not relevant to anyone else that isn't like that, right? And only to the people that are, because they're not going to come tell you, be like, you guys just don't realize, like, I have this terrible first world problem of all this money, right? Generally, people aren't like that. Hopefully, at least.
Yeah, I've said things like that in the past, and people just get angry. I think you're stuck up.
Well, I mean, the people that get angry don't realize, maybe they're the ones that don't realize that there are other things that you could do. And you, as just a community member and investor, like, probably would have liked to have heard other options for things that you could have done with your assets. Most people hear Uniswap and they just think of it as a decentralized exchange. Like, I hear Uniswap, I also see it as a decentralized exchange, but I see it as a tool to facilitate the driving of price and the availability for you to be the exchange, the one that calculably can, scrape up all those trading fees right into your wallet. And there's a lot of traders out there, and some of you guys probably are them, right? So, like, market makers are more than willing to facilitate for you to go there and increase the volume per 24 hours, right? And especially if the traders that aren't really paying attention, or they're watching TA or whatever the hell it is they're doing, and they're in a volatile area, those liquidity providers are more than happy to allow them the opportunity to get chopped up, right? By not moving their assets around and playing these games and have more fun with it. It's like a staking protocol for a day or a week. Or maybe even longer for some people, months and months. There's been pools that I've been staked in, and I just move it around from pool to pool to pool in different ranges for like years. And then the fees that you get, you'd probably consider it passive income, but I guess it depends on whether you're still entering the market or whether you plan on exiting the market. And I'm only like 39, so I'm still entering the market. So I don't really quantify anything as passive income right now. I quantify it as availability to be able to print more money than everybody else.
How many pools are you managing at once?
I don't manage more than like 2 to 3 pools at a time, ever. It's too much, way too much work. You shouldn't try to manage more than that, but I guess it depends on your capabilities, right? Some people have entire teams of people that do all these, and they can actually cover all of the pairs. 9 to 13 different pairs, depending. And it would be a dedicated thing where, like, your availability to do it would be based off of your success, right? Just like anything else. It'd be like trying to become an entrepreneur, but everything's riding on you, right? You could make a mistake and lose big too, and then your business just went under doing that, right? Because if you had a team, not many of you could actually have real jobs with income, and everybody would have to take profit. So it's not an easy way to live your life if that was the case. So probably easier to just manage just like the one pool, maybe 2, especially if you're in Hex, Hedron, and Icosa. You could probably find an advantage with 2 of those pools, with 2 of the assets pools between them. And if you're a really big player, all 3 of them. And some of the OG hexagons like don't have a choice. Like, they have the opportunity to be market makers in any of them as they choose, which would probably be beneficial for them if they knew how to use Uniswap as a tool with all these assets that they have anyway. And it would be better for the community too, right? More liquidity facilitates for bigger players to look at that and go, oh, I can actually spend 50 grand without slippage. That's nice, right? I can actually like sell $50,000 without slippage. That's even better, right? There's people that like have that type of money to do those things and not even give a community the time to build that type of revenue, right, in their liquidity pools for those things, and just go test the liquidity pools like within the first few days, right, and wreck themselves too, and then just go bitch about it and complain about it. It's like, why don't you just understand how this shit works and you don't even have to do those types of things? You're just trying to prove a point? Is that what it is? You wanted to be the guy that made a red candle or a green candle on the chart, and that's it? So you can come gloat or bitch about it? It's silly to me. It's exposing on people's knowledge when they behave that way sometimes, but
Yeah, I don't think it's so much knowledge as it is like hubris. Like they just think that nothing's their fault. Whereas like I think everything is my fault. If I get struck by lightning, I'm like, well, why was I in that place at that time?
What a terrible way to live. You gotta let loose, Kevin.
I mean, it's done me well so far, but yeah, it's not like it's not pleasant, but like I'd rather go through all that and then like be wiser of it than just like, I don't know, have my head in the sand.
I'm going to post another. I don't know how many people have seen this. I haven't updated this because I don't really care to, because like I said, it's meant to be just a visual thing. For those people that got to see it when I made it live and then just post it and explain it right away, that was probably pretty fun for those people because it was relevant to them because they got to see everything. But for those who may be concerned that are listening to the whole liquidity thing and were interested about it, and when I was talking about volatility and things like this, I have a nice little visual for you to see. I took the Uniswap liquidity that was on there for the majority of the pair. I flipped it on its side. I slapped it on over the price. And then I put some explanations around some boxes. And yes, those red boxes are actual ranges also that explain further on in the price range that's off to the far right where you can see the numbers there. So if you can wrap your head around how liquidity works, how to use it as a tool, how to visually represent it towards the price, like what I just did here, so you see where those volatile points are, then man, you could be dangerous. Just dangerous enough to have an advantage, and maybe even dangerous to yourself too. Right? Oops, made a mistake.
Yeah, I've lost like a 40 grand in a trade before. In like a day.
You can know everything there is to know, but still make mistakes in this world. So you gotta be careful.
I was trading oil futures and I made like 8 grand, and then I tried to sell it and the market maker wouldn't let me sell it, and then suddenly the price dropped like $2, which is like it's like a 15x leverage, and like pretty much just wiped my account out when I was first learning how to trade. And then I was like, well, maybe I should just make really small size trades from now on until I really know what I'm doing. And fuck these guys, they literally scammed me.
That sucks, man. How long have you been in crypto? Because I mean, is that even yeah, you can answer that, right? That's cool.
Yeah, I'm not too worried that somebody's gonna dox me. Even if they do dox me, I'm constantly moving, and yeah, I don't know, but yeah, I first heard about Bitcoin in 2011. When I was really into silver, I was like, yeah, that, like silver's probably better because, I don't even